Welcome to the deep dive. We cut through the noise, pull out the key insights you need, basically give you that strategic shortcut.
Yeah, saving you time.
Exactly. Today we're looking at Tenon Medical Inc., ticker TNON. It's a pretty volatile microcap in the medical device space, specifically sacroiliac devices.
Right.
We're diving into their Q2 2025 earnings call. And honestly, this one wasn't really about the quarter's performance in the usual sense.
No, not at all. If you just looked at the income statement for Q2, you'd probably think, wow, this company's struggling. But the market saw something completely different. This quarter was all about a huge strategic move, a major transaction.
Okay.
The real question everyone was asking, and what we need to unpack, is whether management basically just reset the whole game plan. Reset the chessboard, you could say.
That's the core puzzle then. That gap between the financials and the market reaction. Let's start with the hard numbers. They came out after hours, August 13th.
Okay.
And these are the kinds of numbers that usually, they tang a stock.
Yeah, they were definitely soft. No way around it. Revenue is only $0.56 million.
$0.56 million. Wow.
Yeah, and that's down, 37% from the $0.90 million they did in the same quarter last year? Big drop.
Okay. And the bottom line?
GAAP EPS loss was minus 36 cents per share. Negative $2.36.
Right. And gross margin. That's always a key one for device companies.
Also took a hit. Contracted pretty sharply, actually. Fell to 43%. Last year was 52%. So quite a decline there, too.
Okay, so just to recap. Revenue down significantly, a decent-sized loss per share, and shrinking gross margins. Sounds like a recipe for disaster.
I think so.
But the stock went up by about 13.6% after hours. How does that happen? What did the market see?
Well, it seems the market just completely looked past the short-term pain. They understood Q2 was sort of sacrificed,
So sacrificed for what, though?
for the future, for strategic optionality. With these microcaps, especially ones like TNON under, say, $250 million market cap, valuation is often way more of the future story than the current quarter's profit or loss.
Right, potential overperformance.
Exactly. And in this case, investors clearly liked the potential created by this big strategic move. They rewarded the promise of growth and scale down the line, not the immediate sales numbers. The whole narrative around the company changed in Q2.
Okay, we absolutely need to get to that strategic pivot, that catalyst. But first, let's touch on something else they did well. Cost control. Because they showed some real discipline there, right?
They really did. Operating expenses, OPEX, came in at $3.1 million.
Which sounds like a lot, but compared to last year.
It's a huge reduction, down 29% year over year. That's substantial savings across the board. G&A, R&D, sales.
How critical was that discipline?
Oh, it was vital. By, really tightening their belt, they managed to bring the net loss down.
Yeah.
It was $2.8 million for the quarter.
Better than the $3.8 million loss a year ago.
Exactly. An improvement. And here's the fascinating part of that trade-off. Yes, they cut spending on sales and marketing, which definitely contributed to that revenue dip we saw.
Right.
But it preserved their balance sheet. They ended the quarter with $7.8 million in cash and, importantly, zero debt.
Zero debt. Okay, so that cost cutting basically gave them the dry power, the financial flexibility to make a big move without having to immediately go raise more money, which would likely dilute existing shareholders.
Precisely. That cash position was the key enabler for the acquisition. It gave them the room to maneuver because these deals, they take resources.
Makes sense. Now, back to that gross margin drop to 43%. Management didn't exactly hide that it was an issue. Why did it fall so much? Was it just the revenue?
Yeah, it was pretty much a direct result of that lower revenue. Think about manufacturing overhead, right?
Yeah.
You got fixed costs, the factory, the equipment, utilities.
Okay.
If you make fewer units because procedure volumes are down 37%, those same fixed costs get spread over a smaller base. So the cost per unit goes up and your margin percentage goes down.
Simple math, really.
Pretty much. Yeah. They expect it to recover as volumes pick up again, especially with the new products coming online.
Okay, that sets the stage. Let's get to the main event. The strategic pivot. The absolute centerpiece of this earnings call was the asset acquisition they closed from SiVantage.
Yep, that was the big news.
It included the SImmetry and SImmetry plus systems, plus something called the SiMPL posterior SI assets. For listeners maybe not deep in this space, what exactly are we talking about? Sacropelvic devices.
Right. So it mainly deals with the sacroiliac joint, the SI joint. That's where your spine connects to your pelvis at the base.
A common source of lower back pain, I hear.
A very common source, often overlooked. Medical device companies like Tenon try to fix this pain, usually through SI joint fusion, basically putting in implants to stabilize that joint.
And Tenon's main product before this was Catamaran, right?
Correct. Just the Catamaran system, which is a specific approach.
Okay.
Now, with this SiVantage deal, boom, they instantly go from being a one-product company to having a whole platform, multiple products, multiple surgical approaches for the SI joint.
Why is that so important in this market?
Because the SI joint market is pretty concentrated. You got some big players who dominate.
Right.
Tenon's strategy here seems to be, we can't beat them on size alone, so let's beat them on breadth. They now have Catamaran, they have SImmetry for a lateral approach, and SiMPL for a posterior approach.
So surgeons get choices.
Exactly. Different patients, different anatomy, different surgeon preferences. Now Tenon can cater to more of them. It widens their potential market, makes them much more competitive.
That makes a lot of sense. Competing with versatility, how did they pay for all this new tech without just burning through that $7.8 million in cash they carefully saved?
That's where the deal structure was, well, pretty clever, I think.
Okay.
They used a mix, some cash, yes, but also stock, royalties that are capped so they don't run away, and then earnouts based on hitting future milestones.
So less upfront cash drain.
Much less. They basically leveraged their own stock and the future potential of the combined company to make the deal happen. It keeps everyone aligned. You know, the acquired team gets upside, and Tenon keeps cash for the integration and actually selling these things.
And they're not just resting on these acquired laurels, right? There's talk of new product launches, too.
Absolutely. They're showing they want to innovate on this new, broader base. Just after the quarter ended, they fully launched Catamaran SE.
Yes.
Second generation. It's a lower profile implant, meant to be easier for surgeons to use.
Okay.
And looking ahead, that SImmetry Plus system they acquired, that's positioned as their next-gen lateral fusion platform. They expect to start the first alpha surgeries with that in Q4 this year.
So integration and innovation happening side by side.
Seems to be the plan. Quick iteration.
Which brings us squarely to execution risk. This is where my skeptical investor hat comes on. Management laid out a 60 to 90-day integration timeline.
Ambitious.
Yeah. Very ambitious, especially for a microcap that just slashed its operating costs by nearly 30%. 90 days to integrate new product lines, sales teams, inventory. It sounds almost too fast. What happens if they slip?
That's the million-dollar question, isn't it? Or maybe the $7.8 million question, given their cash balance. It's the number one risk the market is watching.
Okay.
If that integration takes longer, if training gets bogged down, if logistics stumble, then those cross-selling synergies they're banking up, they won't show up as quickly.
And the Q3 revenue bounce they projected might not materialize.
Exactly. Gets delayed. Management's big bet here is that the assets themselves provide a shortcut.
How so?
Because the acquired lines didn't just bring technology. They brought active cases, existing approvals within hospitals, established distribution channels. It's not just implants. It's access.
So they bought a commercial footprint, not just patents.
Precisely. That's the real value add here, potentially. Yeah. Management even said during the Q&A that this deal radically speeds up their ability to get into conversations with big hospital systems, the GPOs.
Something that's really hard to do as a tiny single product company.
Almost impossible, yeah. You need scale and breadth to get those doors open.
Okay, let's revisit that Q2 revenue softness for a second. Management was pretty frank about why it happened. They basically said they dropped the ball.
They did, yeah. Very candid. They admitted the dip in Catamaran procedures was because the leadership team was, and I think the quote was, a bit obsessed with getting the SiVantage deal done.
Wow.
Yeah. So they put hiring sales reps on hold, focus shifted internally. You know how it goes. A big strategic project can suck all the oxygen out of the room.
But that kind of distraction has real consequences on the top line for a public company.
Absolutely. Lost revenue. But they seemed confident it was temporary.
So their plan for Q3 is a rapid rebound. How fast are they actually merging the sales efforts? Are they waiting for all the financial paperwork to be done?
No, they said cross-selling is starting immediately. Leveraging that existing access they just bought. Training the combined sales force right now. The expectation they set is Catamaran revenue gets back to where it was, plus you add the new SImmetry revenue on top, starting in Q3.
They really can't afford to wait for those audited financials for the acquired assets, which aren't due until mid-October, right?
No, they need to show the revenue momentum now to prove the pivot is working. Validation needs to come quickly.
Okay, another critical piece. Reimbursement. Getting paid. Does adding SImmetry complicate things? New codes, new battles with insurers.
That's a great question, and the answer was actually quite reassuring.
Oh.
Nope, no new complexities there. The SImmetry tech uses the exact same 3 existing CPT codes for SI joint fusion that Catamaran already uses.
CPT codes. Those are the standard billing codes doctors use.
Correct. Standardized medical procedure codes insurers recognize. When your new tech fits neatly into established, well-paid codes, it makes the commercial side much, much smoother.
Less friction to getting paid.
Way less friction. Plus, the deal came with clinical data supporting SImmetry, which further strengthens their case for reimbursement. So that's a significant de-risking factor.
Okay, that is definitely a positive. So looking ahead, what are the concrete things, the data points, we should be watching for in the next few months? The catalysts that could really move the needle here?
2 main ones. First, and probably the most watched, will be the filing of those audited financials for the acquired SiVantage assets.
Expected mid-October, you said?
October, yeah. That document gives investors the first real clean look at the historical financial performance and scale of the business they just bought. It's crucial validation for the whole strategy.
Okay, audited numbers in mid-October. What's the second catalyst?
Clinical data. They're still planning to publish the second interim analysis from their main sale post-market study. That's for Catamaran.
This quarter, you mean Q3?
Expected this quarter, yeah. And this data dive will look at key patient outcomes, specifically VAS and ODI scores.
Can you quickly remind us what those measure?
Sure. VAS is the visual analog scale, basically, how much pain the patient reports. Lower is better. And ODI is the Oswestry Disability Index. It measures how much the back pain impacts their daily function, their ability to do things. Again, lower scores mean less disability.
And they're also looking for fusion.
Crucially, yes. They'll be looking for confirmation of bone fusion across the SI joint using CT scans.
So if they show good pain reduction, improved function, and evidence of fusion.
That's powerful stuff. Really strong data for the sales team to take to surgeons and for discussions with payers about the value of the procedure. Demonstrates real patient benefit.
Makes that data release pretty high stakes then.
Definitely.
All right. We've hit the numbers, the strategy, the execution risks, the potential catalysts. I think it's time for our, this is not financial advice segment.
Okay, let's do it. But preface first, extreme volatility warning here. This is a microcap.
Understood.
The stock, even after the post-earnings pop, is still down massively over the last year, something like 68% down.
Ouch.
Yeah. So it's trading almost entirely on hope and potential,
Yeah.
balanced against that execution risk we talked about.
But the argument is the potential just got a major boost from this acquisition.
That's the core thesis. The company just made a huge, potentially game-changing pivot. The market gave it an initial thumbs up, but it's still trading well below recent highs. That might create an opportunity.
A short-term, high-conviction kind of opportunity.
Exactly. A momentum trade, really. Betting that management can actually pull off this integration quickly.
Because the entire thesis hinges on them hitting that 60, 90-day target.
100%. It's all about speed and successfully integrating to get that scale. If they do it, that mid-October filing of the audited financials could be the trigger.
The moment the market says, okay, this combined entity is real and here's what it looks like.
Yeah, potentially accelerating the momentum. Or positive clinical data could do it too.
All right, lay out the speculative trade idea then.
Okay, again, not financial advice. But the idea would be, go long, TNON common stock. But because it's so risky, you'd need a very tight stop loss. Maybe base it just below that pre-call price, around $1.18, acknowledging that any integration hiccups could send it right back down.
Protect the downside. What's the potential upside target?
You'd be betting on a bounce back towards the recent 1-month high. That suggests potential upside of maybe up to 48% from recent levels.
Oh, wow. Okay. Significant potential gain, but significant risk.
Absolutely. The whole trade lives or dies on that mid-October filing landing well, or the main sale data being positive, proving they're turning that new portfolio into actual procedure growth, quarter over quarter.
A classic high-risk, high-reward, microcap pivot play.
Got it. Okay, let's wrap this deep dive up. The big takeaway from Tenon's Q2 2025 call.
I'd say they basically hit the reset button. They traded some near-term pain, the lower Q2 revenue, for what they hope is substantial long-term value, a much bigger product portfolio, more shots on goal, and critically better commercial scale in that SI joint market.
They reset the chessboard.
That's the perfect analogy. So connecting this to the broader medtech world, we see consolidation happening all the time in these niche device segments.
Constantly. Bigger fish swallowing smaller fish.
Which leads to maybe a final provocative thought for you, the listener, to chew on.
Okay.
Did this SiVantage deal mark the end of Tenon's M&A? Or is this just the first step? Could Tenon now be trying to become a small-cap consolidator itself in the SI joint space, using this new breadth as a platform to roll up even more?
Interesting question. Are they the target, or are they becoming the hunter? Food for thought.
Definitely. Remember, knowledge is power, but only when you understand it and think about how to apply it. Thanks for joining us for this deep dive into Tenon Medical.
See you next time.